Namaste and welcome to course number 6, that is Institutional Trading Framework. I am your financial guide from Fintamin. This is the most advanced course in the Fintamin series. If you are here, you have already completed technical analysis and FNO foundations. You understand charts, Greeks, and option strategies. Now I am going to show you how the professionals, that is the institutions, the FIIs, the prop desks actually operate. And more importantly, how you can align your trading with their behavior instead of being on the wrong side of their moves. In 18 modules, we will cover VWAP strategies, market profile, advanced open interest analysis, max pain and gamma squeeze mechanics, smart money concepts, the Wyckoff method, FII and DII flow analysis, sector rotation, event based trading, Kelly criterion position sizing, and finally, how to build your own sustainable trading edge. This is the course that separates informed traders from disciplined professionals. Now, let us begin. 18 modules covering the complete institutional trading framework are Module number 1 and 2 are institutional versus retail thinking and order flow analysis, including tape reading and footprint charts. Module number 3 and 4 are VWAP strategies and market profile. Module number 5 and 6 are Advanced OI Analysis and Max Pain. Module number 7 is Gamma Squeeze Mechanics. Module number 8 is Smart Money Concepts. They are Order Blocks, FVG, and Liquidity Sweeps. Module number 9 is the Wyckoff Method. Module number 10 is Dark Pools and Block Trades. Module number 11 and 12 are Sector Rotation and FIIDIF Flow Analysis. Module number 13 is Derivatives Data Signals. Module 14 is Algo Trading Basics. Modules 15 and 16 are Pre-Market Analysis and Event-Based Trading. Module 17 is Advanced Position Sizing, that is Kelly criterion. Finally, module number 18, which is the last module, module number 18, that is the last module, is Building Your Edge. Let us begin with the course. Module number 1 is Institutional versus Retail Trading. The most important mindset shift in advanced trading is understanding that you are not trading against a computer or an index. You are trading against some of the most sophisticated market participants on the planet. Let me show you how they operate. Who are the institutions? 5 types of institutional participants control 70 to 80% of daily market volume in India. Number 1 is FIIs, which means Foreign Institutional Investors. Global banks, hedge funds, sovereign wealth funds from the US, Singapore, and Europe. Their buying and selling is the single most powerful driver of Nifty direction. When FIIs are net buyers for 5 consecutive days above 2000 crore rupees daily, Nifty has historically risen 3 to 5% over the following 2 weeks. When they sell, markets fall. Track the data daily. Number 2 is DIIS, which means Domestic Institutional Investors. LIC, HDFC Mutual Funds, SBI Mutual Fund, insurance company, etc. They act as a counterbalance to FII flows, buying aggressively when FIIS sells. This DII cushion is why India's market have become much more resilient to FII selling over the last decade. Third is proprietary trading desks, brokers trading firm capital. Very active in F&O, especially intraday and weekly expiry options. Algorithmic execution. Number 4 is HFT firms, which means high frequency traders. Jane Street, Citadel, and domestic HFT firms execute millions of trades per day in microseconds, account for over 60% of NSE F&O volume. They provide liquidity. Your trades match their quotes. They are not your enemies, but they are faster than you and they exploit prices inefficiencies that last milliseconds. Last is retail investors like you and me. 20 to 30% of volume. The liquidity that institutions use, understanding institutional behavior, tells you what retail trading looks like from the other side of the trade. Now, institutional versus retail key differences. Let me give you a comparison table that crystallizes the mindset difference between retail and institutional trading. First point is research. Now, retail reads news and tips. Institutions have fundamental analysts, quant teams, satellite data on parking lots of Walmart stores, credit card transaction data. You cannot match their information, but you can read their footprints, which is what this entire course teaches. Second point is execution. Retail uses market orders and acts on emotions. Institutions use VWAP and TWAP algorithms to execute large orders without moving the market against themselves. Use limit orders always. Third point is risk management. Retail might have a mental stop loss. Institutions have hard position limits. That is, automatic stops that close positions immediately when reached. No exceptions, no overrides. Your stop loss order must be placed as an actual order, not a mental note. Next point is review. Retail rarely reviews trades. Institutions have daily P&L attribution. Every single trade reviewed, every loss explained. Your trading journal is the institutional grade habit that is available to any retail trader. Use it. The most important insight is you cannot match institutional capital or information, but you can match their discipline, their process, and their systematic approach towards markets. This is the entire premise of this course. Let me tell you how institutions build positions. Here is what institutions cannot do that you can. They cannot buy 500 crore rupees of Reliance in one order. It would move the price against them dramatically before they finish buying. So they buy in small pieces over days or weeks. And this process creates the chart patterns you have been learning to identify. Accumulation. Institution wants to buy 500 crore of a stock. They buy small lots consistently over 2 to 3 weeks. Price stays in tight range. Every time seller appears, the institution absorbs them. Volume is steady but not dramatic. This is the boring sideways consolidation you see on charts before explosive breakouts. Now you know why the breakouts happen. The institution finished accumulating and is ready to let price rise. Next is distribution. Institution wants to sell 500 crore of a stock at the top. They sell into every rally gradually so price does not crash. Volume on up days starts declining. New highs are made on low volume. Then suddenly price drops. The institution has finished selling and retail is left holding overpriced stock. Next is liquidity hunt. Before making a major move, smart money sweeps obvious stop loss levels. Price briefly breaks below a key support, triggering all the retail stop losses, then immediately reverses upward. This is called a stop run or a liquidity sweep. The false breakdown was the institution filling their buy orders at the best possible price at the levels where retail was forced to sell. Watch for these three patterns on weekly charts. Tight range plus rising OI equals accumulation. New highs plus declining volume plus large blocks being sold equals distribution. Brief false breakdown that immediately reverses equals liquidity sweep. The real reversal starts from here. Let us go deeper into how institutional trades actually look in real time. From module number 2, that is order flow analysis. The order book, tape reading, and footprint charts. This is how you see institutional activity in real time before it shows up in the price chart. Most retail traders have never looked at these tools. This gives you an edge. Understanding the order book. The order book has level 2 data, shows all pending buy orders at prices below the current market and all pending sell orders above it. It is a real time window into supply and demand. A large cluster of buy orders, a bid wall, at a specific price signals strong institutional interests to buy at that level. The larger the wall, the stronger the intended support. When price approaches, these buyers absorb selling and push price back up. A large cluster of sell orders is an ask wall. At a specific price signals strong resistance. Sellers are accumulated there, waiting to unload. Here is the critical warning. Institutional players sometimes spoof. That means place large orders they have no intention of filling to create the appearance of support or resistance. When price approaches, they cancel the order. Real institutional intent is only revealed when orders are actually executed and filed, not just placed. Always combine order book reading with time and sales data. The actual trade tape. Trade read. Tape reading. Time and sales. The tape shows every executed trade like price, quantity, and time. Institutional aggression shows in the tape before it appears in the price chart. Large lot trades at the ask price means someone was willing to pay the offer price to buy immediately. Aggressive buyer. Institutional accumulation and bullish signal. Large lot trades at the bid means someone sold at the bid immediately. Aggressive seller. Institutional distribution. Bearish signal. Iceberg orders appear as repeated trades of the exact same size, like 500 lots, 500 lots, 500 lots, at the same price level. An institution is hiding a very large order by breaking it into equal chunks. The repeated size pattern reveals the iceberg. Sweeps are when a large buyer or seller hits multiple price levels in rapid succession. The order is so large that it consumes all available liquidity at the first level and continues up or down through multiple prices. Sweeps indicate very high conviction, an institution that needs to be filled immediately regardless of price impact. Extremely bullish or bearish signal. Footprint charts. Footprint charts are the most advanced form of order flow analysis available to retail traders. They show at every price level inside a candle how much volume traded at the bid versus the ask. First one is delta. In footprint context is buy volume minus sell volume at each price level. Candle that closes green but has a negative total delta means sellers were actually more aggressive than buyers. Price went up but selling pressure was building. This is bearish divergence in footprint terms. Second is point of control is the price level with the most total volume in a session. Markets are drawn back to POC. If price moves significantly away from POC, expect a return visit. If price opens 150 point above yesterday's POC on a slow news day, there is a good chance price returns to POC before the day ends. Platform for footprint. Bookmap, ATS, Sierra chart, and increasingly TradingView in paid plans. These are paid tools. Start with TradingView's volume profile first, which gives you POC and value area for free. Foot Graduate to full footprint charts after 6 months of the experience. Now, the most important intraday tool used by every institutional desk in the world is VWAP. Module number 3 is VWAP strategies. Volume weighted average price. Every mutual fund manager, every prop desk, every institutional algorithm in the world benchmarks their executions to VWAP. Understanding it gives you a massive intraday edge. What is VWAP and why it matters? Let me tell you. VWAP is the average price weighted by volume. Formula: sum of price times volume divided by total volume. It resets at the open of every trading day, that is 9:15 a.m., and continuously recalculates throughout the session. Why do institutions care about VWAP? Because fund managers are evaluated against it. If a fund manager buys below VWAP, they got a better than average price. If they bought above VWAP, they overpaid. This creates a self-reinforcing dynamic. Institutions want to buy below VWAP and sell above VWAP. This institutional behavior makes VWAP a support level when price is above it and a resistance level when price is below it. Price above VWAP. Bulls are in control on average. Institutions looking to buy will wait for pullbacks to VWAP. Only take long trades above VWAP. by pullbacks to VWAP, price below VWAP, bears in control. Institutions looking to sell will use rallies to VWAP as exit opportunities. Only take short trades below VWAP, short rallies to VWAP. Price at VWAP is equilibrium. Wait for a clear break and hold above or below before committing to a direction. The majority of intraday volatility happens around the VWAP level. VWAP trading strategies. There are 5 proven VWAP setups. I use them in my own trading. Let me tell you all the 5 strategies. Strategy number 1 is VWAP bounce. Market is in a clear uptrend. Price above VWAP. Higher highs and higher lows. Price pulls back to within 5 points of VWAP. Volume dries up on the pullback. A bullish reversal candle forms at VWAP. Enter long. Stop 10 points below VWAP. And the target today's high or previous resistance. This is the single most reliable intraday setup I know. Strategy number 2 is VWAP rejection. Mirror image. Market below VWAP in downtrend. Price rallies to VWAP. Bearish candle forms. Volume dries up. Short the rejection. Stop 10 points above VWAP and the target is today's low. Strategy number 3 is VWAP breakout. Price consolidates near VWAP for 30 or more minutes in a tight range. Volume declining during consolidation. Then price breaks cleanly above VWAP with volume 1.5 times average. Enter on the breakout candle close. Stop back inside the consolidation and the target is 1.5 times the average true range. Strategy number 4 is opening VWAP. Watch the first 15 minutes. When direction does price go relative to VWAP? Which direction does price go relative to VWAP? If it opens above, consolidates and holds above VWAP for the first 15 minutes, the day's bias is bullish. Trade with that bias until price proves you wrong. Finally, the last strategy, that is strategy number 5. VWAP means reversion. Price moves 2 or more standard deviations from VWAP with no news catalysts. Fade the extreme. Enter against the move. Target or return to VWAP. Works best on calm, range-bound market days. Anchored VWAP. Anchored VWAP is one of the most powerful tools in the institutional trader's arsenal and almost completely unknown to the most retail traders. Instead of starting fresh each day, you anchor VWAP from a specific significant event. Anchor from the major swing low. This gives you the fair value of the entire move from that low. If Nifty has been in an uptrend from March low and keeps respecting the AVWAP from the that low, the trend is healthy. When price first returns to this AVWAP after a prolonged rally, institutional buyers who missed the initial move will often step in here. Anchor from a major earnings gap. If TCS gaps up 8% on strong results, anchor VWAP from that day. The AVWAP becomes the fair value of the new reality post earnings. As long as TCS stays above its post earnings AVWAP, institutions are not selling. The trend is intact. Anchors from budget day or RBI policy gives you the market's average cost since the macro event. Nifty above budget AVWAP 1 month later means the market has digested and the budget positively, which means the market has digested the budget positively. Institutional net buying since then. Powerful macro context. It is available on TradingView Pro. Draw it by right-clicking on the specific candle and selecting Add Anchored VWAP. VWAP Standard Deviation Bands. VWAP standard deviation bands create a statistically derived normal range around VWAP plus 1 and minus 1 SD contain approximately 68% of the day's price action. Plus 2 and minus 2 contain 95%. When price reaches plus 2 SD on a calm day, it is statistically very extended. The probability of returning to VWAP is high, means reversion short setup. Stop above the 2 SD level. Target is VWAP. When price reaches minus 2 SD with no news and market calm, statistically oversold. Long mean reversion trade. Stop below the 2 SD level and the target is VWAP. Rule is only trade VWAP SD mean reversion on low volatility days when India VIX is below 50. On high volatility days like budget, RBI, major news, 3 and 4 SD moves are possible. Mean reversion strategies fail on extreme volatility days. VWAP is real-time market profile analysis, the entire day structure in module number 4, that is market profile. Developed in the 1980s for the Chicago Board of Trade. It organizes price data by time spent at each level, revealing where the market found genuine value and where it was rejected. This tells you tomorrow's key levels before the market opens. What is market profile? TPO stands for time price opportunity. Each letter in a market profile represents a 30-minute trading period. A equals 9 to 9:30 a.m. B is 9:30 to 10 and so on through the session. When many letters stack at the same price level, the market spent a lot of time there. Acceptance. When price passes through quickly with few letters, rejection. Value area is the range containing 70% of the day's TPO count. This is where the market found fair value. This is where the market found fair value, where buyers and sellers agreed on price. The value area high, that is VAH, and value area low, VAL, are critical levels for the next session. Point of control is the single price level that with the most TPO letters, the busiest price of the entire day. This is the most accepted price. Tomorrow, price will often return to test today's POC before establishing a new direction. The first action every morning. Note yesterday's POC VAH, and VAL on your chart. These three levels predict the majority of the next session's support and resistance. Mark them before 9:15 a.m. Every professional I know starts their morning with market profile levels. Market profile trading rules. 5 rules for trading market profile levels. Rule number 1. If today opens above yesterday's VAH. Rule number 1. If today opens above yesterday's VAH, market rejected yesterday's value and opened higher. Bullish day expected. Buy dips that hold above VAH. Rule number 2. If today opens inside yesterday's value area, market is exploring the same value as yesterday. Direction unclear. Wait for price to break out of the VA before committing. Rule number 3. If today opens below yesterday's VAL, bearish, sell rallies that fail to reclaim VAL. Rule number 4 is when price returns to yesterday's POC, expect consolidation. Institutions recalibrate around this level. Often the day's range is centered on POC. Buy below POC, sell above in a range day. Rule number 5 is gaps from the value. Area tend to fill. If today opens 200 points above VAH with no major news, the gap back down to VAH is a high probability fade trade. Markets hate unsupported gaps. Profile patterns. Market profile creates distinctive shapes depending on what type of the day it was. Recognizing the shape tells you about institutional participation. Normal day is bell-shaped, wide in the middle, narrow at extremes. Range established early. Institutions found fair value quickly. Range-bound session. Buy VAL, sell VAH for the rest of the day. Trend day. Elongated to one side. Almost all letters stacked in one direction. Institutions were aggressively one directional all day. Very rare. Maybe 3 to 4 times per month. When you identify one early, ride it. Do not fade it. Do not take profits early. Trend days are where the biggest gains happen. Double distribution. Two distinct value areas separated by a gap. A thin area of low TPO count. This represents an inflection point. The market changed opinion mid-session. Very significant for next day reference. And the last one is P-shape. Long lower tail with fat top. Sellers tried to push down. Buyers absorbed all the selling and drove price up. The fat upper area is where the real value was accepted. Bullish. Now our deep dive on open interest is module number 5, that is open interest mastery. You learned OI basics in course number 4. Now we go deeper into rollover analysis, OI concentration patterns, and how to use OI data as a directional trading signal. OI interpretation, 4 scenario framework. The 4 OI scenarios you must memorize. Price rising plus OI rising. First one is price rising plus OI rising. The 4 OI scenarios you must memorize. Price rising plus OI rising. Long build up. fresh long positions being built, institutional accumulation, genuine bullish momentum. Follow the move with confidence. Second is price rising plus OI falling. Short covering. Bears are closing positions, buying back their short futures or letting short options expire. The rally may be sharp, but it is not backed by fresh buying. It may exhaust quickly. Be cautious adding to longs here. Third one is price falling plus OI rising. Short build up. Fresh short positions being built. Institutional distribution. Genuine bearish momentum. Follow the downside. Next is price falling plus OI falling. Long unwinding, long holders are exiting. Selling pressure but no fresh shorts being added. Market may stabilize soon. Watch for exhaustion of selling. Check these every evening on the NSE option chain website. The change in OI column, not absolute OI, is what matters. Velocity of OI change is more important than the absolute number. The OI interpretation table is also available in the course number 6 PPT on slide 21 with your specific action guidance for each scenario. Let me give you 5 specific actionable signals from OI data. Signal number 1 is highest call OI as resistance. Every Monday morning, open the NSE option chain for the current week's expiry. Identify the strike with the highest total call OI. This is where option writers have the most inventory to defend. Market will likely be capped here for the week. Short rallies towards the strike. Do not buy above it without a strong catalyst. Signal number 2 is highest put OI as support. The strike with highest put OI is where writers defend the downside. Buy dips towards this level, especially when PCR is above 1. Signal number 3 is PCR extreme above 1.3. Mass put buying equals extreme fear equals contrarian buy signal. This has signaled bottoms before major Nifty rallies multiple times. Post-COVID in 2020, post-rate hike fear in 2022, and multiple other occasions. Signal number 4 is sudden OI addition in par OTM puts. When you see massive fresh OI added in 5 to 8% OTM puts, strike far below current price, it means large institutions are buying portfolio protection. They know something the market does not. This is the warning signal. Reduced long exposure. Signal number 5 is rollover data. Market-wide Nifty futures roll over above 75% with positive basis going into next month's expiry equals institutional consensus bullish. Below 60% equals uncertainty. Track this around the 28th to 25th of each month. Now the expiry day mechanics. Max Pain, pin risk and how to trade them. We will learn about all this in the next module, that is module number 6. I would request all the viewers to please subscribe to stay updated with latest educational videos and visit fintamin.in for more insightful knowledge on stock markets and financial planning. Also visit www.fintamin.in for your free financial health report. Thank you. See you in the next video.